part of this job is always being a bit top of mind. So when you think of an opportunity, you come to me. But fortunately, I've been around long enough now that background, reputation building definitely helps. And it's people behind the scenes being like, oh no, you should go and talk to Taryn and talk to Rampersand because, they're great people and they're great humans and they're the investors that you want on your cap table, which is really special. And we definitely don't take that for granted. We are constantly reminded you've got to continue delivering on that promise to have that reputation.
Hi everyone, I'm your host Rohit Bhargava and you're listening to episode 190 of the Startup Playbook podcast, a weekly series where I sit down with successful tech founders, investors and operators to unpack their journey, lessons and insights to help current and future entrepreneurs. The voice that you heard a little bit earlier was that of our guest for this episode, Taryn Pieterse. Taryn is a partner at Rampersand, a dedicated seed fund that has invested over $100 million in over 30 companies. In this episode, we covered a wide range of topics, including Taryn's journey from investment banking into tech and VC, Rampersand's AAA approach to investing and supporting startups, the insights and value that you can get from building financial models, and much more. Without further ado, here is my interview with Taryn Pieterse. Hi, Taryn. Welcome to the Startup Playbook podcast, and thanks so much for taking the time to be on the show today.
Thanks so much for having me.
My pleasure. So Taryn, for those people that may not be as familiar with you and your background, do you want to share a little bit about your story and what got you here today?
Yeah, absolutely. So I grew up in Brisbane, born and raised, and at the end of my university degree, to be honest, I didn't really know what I wanted to do. I was very fortunate enough to have landed an internship at Goldman Sachs in investment banking, and then took that role and started in Sydney with the team there. During kind of that process, I was very fortunate. It was a bit of a weird deal for Goldman to do back in those days, but we helped lead the round for Campaign Monitor when they did a capital raise back in 2013. That's how long ago it was now. Back then, Goldman's didn't really have a proper tech team. We did telecoms, media, but they weren't startups raising capital. And so it was a bit below our usual size of deal that we'd look to do. And we were really scrambling to work out, like, how do we value a business with all the metrics that we'd usually use to help those guys raise some capital. So it was such a cool, different experience for an investment banker. We worked super closely with the two founders, went to their house, heard their story. They'd built it literally from a garage, solving a pain point that they had experienced, and just built an awesome business, but didn't have that next of, okay, well, where do we go now? I think they already had global customers and had built a profitable business at that stage. So we helped them really do a whole bunch of metrics and insights into their business they'd never even seen, and then help them think about that strategy going forward. And at that point, as we all know, there was no Australian venture capital, so we were talking to US VC funds and helped them land a really awesome round that they were really happy with, which was great. And so that was, a super fun, different experience for me to say that I had as boring investment banker. So that was awesome. I then took the opportunity to go over to London with Goldman and had almost the totally different experience. I was in the consumer retail health and wellness team there, and I worked on the merger of SAB Miller and AB InBev, which was the two biggest beer companies in the world. At that time, I think it was the 5th biggest M&A that had ever happened. Wow. It was in the papers every day. It was all big and flashy, and everyone in the firm wanted to be on the deal. It was wild though. We had a team of 6 of us at Goldman's working on it, and there was 2 very, very senior partners. And when there were board meetings, but when they were talking about the deal, only one of the partners would get to go in the room, and the other partner would have to sit and wait outside.
Oh, wow.
And you're like, wow. That just wasn't interesting to me. You wanted to be in the room, you wanted to be part of the conversation, you wanted to actually feel like you were having an impact rather than being the Excel person tweaking the numbers on the back end and having a really small piece of that whole, very cool, but process. We were just such a small piece. So, but very cool, very awesome opportunity. I spent the 18 months I was in London basically just talking about beer. And we ended up doing a whole bunch of research into all of the European beer companies, and that was awesome. So loved that experience. But when I was to be honest, I'm burnt out. Time to move on from Goldman's. I reflected on those 2 experiences and I was every day of the week, I'd much rather be working closely with the founders, helping them understand their business and where to next, versus working on the cool, flashy, high profile, big M&A deals. And so I was very fortunate when I was looking to come back to Australia. One of my old Goldman's colleagues had just left to join Radek Sali's family office. He was the Swisse Wellness CEO. Goldman had just sold that business to BioStime, and he was helping launch that family office. So I went and joined those guys in Melbourne, which is cool. So I spent 3 years here working for that family office, still like in an investing role. So most of what I did was on the ventures side, but not tech investing. It was physical product, health and wellness, restaurants, and other things you can feel and touch and have real operating businesses behind them and a lot of staff. So yes, spent 3 years working for that team. And I guess once again, my experience from that was I loved working with the founders. We got very operationally involved and getting really hands-on, helping them where we could. And that was the piece, once again, wasn't really the product, although that was very cool. We invested in a yoga festival business called Wanderlust. We're investors in a high-pressure processed milk business called Made by Cow, which was awesome. And then we were invested in George Columbaris's restaurant chain called Made Establishment. And once again, decided to leave that business, probably on that side of burnout almost again, but recognized the signs this time. And I was like, look, I loved this experience, but worked incredibly hard. And as I decided to leave, we had decided, unfortunately, to put the restaurant chain into administration. It just hadn't been working for a long time. There was a whole bunch of media challenges around that. But yeah, I think we decided to put that in administration, and it was pretty heartbreaking, to be honest. I had been working very closely with that business for the better part of 3 years, getting really deep into their models, helping with them with the COGS, helping them pick suppliers and random stuff like that. And then, yeah, unfortunately, as we all know, in venture and any time of investing, we just couldn't make the business model work. And so that was really heartbreaking. And so I still reflect on that and I'm still sad. But I think what it did teach me, and what an important learning I've taken to Rampersand and continuing to invest in tech founders, is never underestimate how challenging this is for a founder. I guess we were sharing an office with them. I saw that every single day. You're working so hard. Your blood, sweat and tears is literally in this business. And sometimes things just aren't going to work, and sometimes things are a bit out of your control. And so people always talk about founder empathy, but it's such a hugely important part of this business that any investing is acknowledging we're not the founder. But every day they get up and they're doing what they love, but they're pouring so much of themselves into that. And it's really, really hard.
Yeah.
I think the other thing I learned, which is really interesting, I was reflecting on it. Why is tech investing different to that type of investing that we were doing? And one thing, and as you, I'm sure know, Rampersand are investors in Cake Equity, and we think that employee options are really, really important in the tech industry. And there's hopefully a lot of people recently who have benefited from having some employee options. And you didn't really get that in non-tech investing. And it's so important, that ownership mindset for any employee or team member, as we like to call them, within an organization. At the restaurants, we had 25 different small businesses running. Yes, there was shared services and everything, but every single manager in that restaurant needed to be sweating the COGS, the wastage, selling that extra glass of champagne as an example. And without kind of an options process to do that, you really had to instill, this is your restaurant. Your performance here is really important. And fortunately in that restaurant, in the restaurant industry, they love it. And those restaurant managers are like, no, this is my business. I'm going to do my best. But continuing to create that is super, super important. And probably the third thing I learned was COGS is really hard. Literally looking at wastage, literally sweating on how many pieces of tomato do you put on this is super, super challenging and much more difficult than what we necessarily look in tech. But what you take over from that side of the business to tech is you need to understand the drivers of your business. And maybe it's not COGS, you're not necessarily, stressing on that, although making sure you've optimized your architecture is crucial. It's how do you understand the levers of your business? So when you miss your forecast, I'm not going to say if, everyone misses their forecasts, but when you miss your forecast, understanding why, do you understand the levers that you missed? And what changes do we need to make? And maybe the answer is none. It's often none, but understanding why things were missed, or what can we change, or what did work, and let's double down on that. So I had a lot of reflection on that journey. Just as I resigned from that job, very fortunately, and this is Melbourne's small ecosystem, I got introduced to Paul, and we met for coffee in Cremorne. And just as I was literally fleeing Melbourne when they were about to close the borders that time, Rampersand was just about to hire for a role, and maintain that relationship with Paul. I managed to land the role at Rampersand. And I feel like I've been talking a lot, but I've been with Rampersand for 4 years now. I was recently promoted to partner, which is super exciting. And yeah, enjoying jumping into still working with founders, still supporting them in their operational role, but just now focused kind of in the tech sector, which has, like, look, it's not a yoga festival, but often it's still pretty fun.
Yeah. First of all, congratulations on making partner.
Thank you kindly.
Really well deserved. And obviously, as you mentioned through your intro to your background, so many different parts of your story that we'll dive into. As a starting point, maybe just going back to the very first thing that you said of you not being sure exactly what you wanted to do when you grew up. I think it's a challenge for a lot of people at just various stages of their career. And as someone who's very smart and capable, one of the challenges is often you've almost got an unlimited amount of opportunities ahead of you, and it's hard to make the decision to understand what the right next step is. It's always a combination of just being in the right place at the right time, certain conversations, those sort of things. But I guess it sounds like in hindsight, it's probably a little bit easier to connect the dots, but sounds like you were a little bit more deliberate or had a more conscious way of making decisions on what you were going to do next.
Absolutely not. 100% no. I think I've been very blessed in my career, but also I think something that is super important and something I realized from a really early in my career is always just do the best job and have people being like, you want to work with Taryn because she does what she says she's going to do. She's a super safe pair of hands. She's always ready to help. And so even though I had absolutely no idea what I wanted to do, zero, when I was like, oh, actually investing at the family office seems like a really interesting opportunity, I had people who were like, oh yeah, like I want to work with you, or yes, I think you'd be the right person for this role, and offered me up for the things. And same with Paul. I had worked with Janie Martino at Light Warrior. She came in and ran the yoga festival business for a short period of time. She was a co-investor in one of Rampersand's businesses. And so when I was looking for a new job, she was like, you must meet Paul, and I'll tell Paul wonderful things about you, which she did. And I'm so very grateful to still have her in my network. But yeah, like it's a bit of a testimony, and I wouldn't suggest this to anyone necessarily, but being very deliberate and making sure that you hopefully give everyone that you meet in your orbit a good experience. They want to say great things about you. You'd have to work really hard to do it. But yeah, I think I've been blessed when there's been these amazing opportunities that have come up in my career. There have been people advocating for me and telling other people, you'd be crazy not to hire her, which I think what Paul heard, and still took him a couple of months, but he came around.
Yeah, I think that's a really valuable point. I think obviously when a lot of people talk about personal brand in some ways, everyone's talking about how many people are seeing my content on LinkedIn, for example, but actually it's exactly what you mentioned is what is the reputation that you have with people that you work with that are close to you, that want to vouch for you or want to actively seek you out for opportunities that they've got or help you out with things that you want to explore.
Yeah, absolutely. And once again, everyone in tech is always talking about scaling, and LinkedIn's a great way to scale. And to be honest, part of this job is always being a bit top of mind. So when you think of an opportunity, you come to me. But fortunately, I've been around long enough now that, yeah, that kind of background reputation building definitely helps. And it's people behind the scenes being like, oh, no, you should go and talk to Taryn and talk to Rampersand because, you know, they're great people and they're great humans and they're the investors that you want on your cap table, which is really special. And we definitely don't take that for granted. We are constantly reminded you've got to continue delivering on that promise to have that reputation.
And obviously a lot of this podcast is centered around sort of founders, investors, but there are quite a few operators within startups that listen to this as well. And I think operators are just the fuel behind all of these companies. They're such a critical part of this, but often don't really get the spotlight, and we don't really talk about them a lot on the show either. But I guess from your perspective, I love what you said about just how do you become someone who's really like valuable and do things that you say. What does that look like for you, or for someone who's listening? How do they become someone who's really critical to a company, or I guess elevate their own performance within a company to provide as much impact as they possibly can?
Yeah, such a good question. I think it's the little things, which sound probably sounds dumb, but if you're in a room and no one's taking the notes, take the notes and send them around and be the person who's like, oh, cool, this person said they'd deliver this and blah, and a week later follow up and make sure that it was delivered, because that's the bit no one wants to do. And if you do it and you show that you can deliver, that's what people love. It's actually getting stuff done that people want to see, right? It's not the navel gazing. It's not talking about it. It's actually demonstrating you're the one that'll get stuff done. And sometimes it's doing the less fun tasks, setting up the meeting, running the agenda, sending the notes. Most importantly, it's hitting deadlines. Like, I think I obviously worked in banking, so like deadlines was drilled into you. Absolutely. But if you say you're going to do something by a set date, do it. Or if for some reason it can't be done, tell people it's not going to get done by that set date. Don't miss the deadline and apologize after. So it really is the little things. And I think that has definitely helped me in my career. I don't care if I'm the person pouring the water. That's not a big deal, right? Because everyone appreciates having the water.
Yeah.
And so, yeah, just constantly having a positive association for everything that you do and that you bring, and that you always just go that extra mile to help people out. I think another thing is, if someone something, be like, oh, here's the answer. And have you thought about this? That's the second bit that I think has really helped me in my career, is not someone being like, oh, Taryn, can you like find this piece of information? You're like, yep, here's the information. And by the way, did you know X, Y, and Z might be interesting as well? And taking that extra time to be like, this is also helpful information, or this will make you look smart in the meeting you're about to go to, even though you didn't ask about it. I'm the one deep in the weeds. I'm the one who's looking at the model. I'm the one who's reading the legal docs. You asked for this specific question, but by the way, these 3 extra bullet points will help you get what we want, or provide extra value to those founders by demonstrating that you've read the materials. Yeah. So it's the little things.
Yeah. I mean, to your point about the little things, I remember when I first joined Amazon, so it was the first job that I had in forever. And I think my first or second week, I launched an internal newsletter, which was just a summary of here's all of the funding news that happened. I thought it was the most basic thing, and people just lost their mind at how valuable that was.
Absolutely.
And I found that such a weird thing of just like, here's something so simple, it'll take me half an hour every week to do. But like you said, it's just people see a ton of value in that, and it's just going that extra mile where no one's asking you to do something, but it helps make other people's jobs or lives a little bit easier. I think people really valued that.
Absolutely. And probably for you, someone was like, oh, I need someone to come with me to this meeting or do this extra interesting task. Oh, you've done something awesome for them. And so they want to help you and do something for you as well. I don't know if you experience that as well.
Yeah, I think it kind of reciprocates, right? And I think a lot of it is just building that trust with people. And I think it's so important, especially at the start of a job, when you're trying to understand how people fit into organizations. I heard this, I can't remember if it was on a podcast or someone tweeted this, but they just said the real A+ performers, you know within the first week or two whether they're going to come in and really hit the ground running. It's very rare to find someone that is a bit slower to start off with and then turns into that. It's just evident within the first couple of weeks. And so, yeah, in hindsight, it's just looking back at a lot of those sort of things, it becomes a little bit ingrained in you. But I guess coming from a startup background, I was like, when you're a founder, you just have to do a million things anyways. But I guess when inside a more corporate or more structured experience, where I guess you have a much more clear set of requirements or outputs and those sort of things, I guess people aren't as used to doing a little bit extra.
Yeah, 100%. I guess Goldman's was slightly different because we were service providers, right? Ultimately, our job was always to make our client look good. And I think that's still a job as a VC, is our job is always to help our founders, our portfolio companies, anyone within those organizations. How can we help you do anything or help you look good or always be working for you? So I don't think people really talk about VC as being service providers, but I guess that's how I still visualize us, is we're really just here to help the founders unlock their potential and achieve their dreams.
Where do you think that came from for you?
Oh, good question. I think I just have always liked to help people. And I guess had the opportunity to do some of that. I was a big nerd. So as an example, people were always like, oh, have you done the homework? Can you help me do it? Or how did you research this assignment? And so I think from a young age, I was always just trying to help my friends and enjoy doing that. And then, yeah, Goldman, it's totally ingrained with you, but it comes pretty naturally to me and probably people who work there, is you're always your job is to make sure that the next person looks good and the client looks good, and to the dumbest point of don't have double spaces or full stops where you're not supposed to have them. But that micro detail just means you're always in that headspace of how am I helping? And that's my job.
Is that ingrained into Goldman's company culture, or things that they teach you to the company?
Yeah, I think so. Yeah. It was I have to reflect on it, because Goldman was like, we have great culture. And then you leave and you're like, oh, wait, no, that wasn't culture. And now I would say at Rampersand, we do have great culture. But yeah, I think definitely was, we're service providers. We're here to help. And it looks a bit differently, obviously, now, because we actually are hands-on. We get involved. We're not just advising people. But yeah, it was definitely part of the culture of we're just advisors. We're helping these amazing companies. Let's do that to the best of our ability.
We're going to take a very quick break from this podcast to talk about an important issue, which is the growth of your business. Specifically, how long sales cycles when selling to large enterprise customers can slow down progress for so many startups. Unfortunately, a portion of this is out of your control, but something you can do to accelerate your sales cycles and sell to bigger customers is to demonstrate your security compliance with standards like ISO 27001 or SOC 2. The problem is that achieving compliance can be a big distraction and a large financial and operational drain for your company. Thankfully, our partners for the show, Vanta, can help with this. Vanta automates up to 90% of compliance, getting you audit ready quickly and saving you up to 85% of associated costs. And Vanta scales with your business, helping you continue to compliance, unify risk management, and streamline security reviews. There are over 7,000 fast-growing companies like Atlassian and Dovetail that use Vanta to build trust and prove security in real time. They've been supporters of the show for a while now and are doubling down in their support for our community by offering $1,000 US off their plans. To access this exclusive offer, head over to vanta.com/playbook. That's VANTA.com/playbook. All right, let's get back to this episode. And you referenced Campaign Monitor, which I believe they raised a $250 million round at that time, led by Insight.
Yeah. Yes, I'm pretty sure that was about right. I should have actually relooked at the numbers. But yes, it was a huge round. And I think if you look at the charts of the startup ecosystem 10 years back, it's like this big blip in 2013, which was very cool to be involved in.
Yeah. And I guess even from an Australian context, up until more recently, or even recently, there's not a lot of rounds that kind of take place of that size.
Yeah.
What was some of the learnings? What was that experience like for you, and what did you take away from that you think about even just helping portfolio companies now?
Yeah. So one of the things probably is you get the opportunity to not be in the business and be one step removed. And that's really powerful. The founder is just so in the weeds all of the time. And so just being one step removed, you can look at, a big part of that job was just understanding their metrics. Back then, the software to do that wasn't that good. So I literally was there at 3 a.m. running these massive pivot tables to do their cohort analysis for them. And they'd just actually never done it before. And they never had to, because they were doing incredibly, incredibly well. But the potential investors were asking for it. And so we did this whole cohort analysis bit, and sharing that data back to them and be like, oh, by the way, did you know this? And actually the cohort retention's improving, or here was a weird month and could we dig into that? Yeah, so sharing back information, but also being one step removed. So I think they hadn't even thought about a strategy for expanding more globally. They had customers globally, but it wasn't something they'd thought about deeply. So it was something we then said, okay, well, let's look at where your customers currently are that you've organically attracted, and let's see if we can think about a strategy of how will you expand and have a presence in those regions, or where should you focus that next phase of growth. So yeah, it's one, being an extra resource a little bit, and then just being a step back and asking a couple of questions that they probably don't have the space in their mind to stop and think about. And that's what I think a lot of our job as venture is just asking some questions that the founders, because they're so in the weeds, don't get a chance to take a step back and be like, oh wait, are we even approaching this in the right way anymore? We've been focused on it for so long. Do we need to think this isn't working, or actually this piece of it is the star here, and let's just double down on that and maybe let a little bit of this other stuff go.
I think that's such an important point, because I think founders, they have a sample size of one. They go really, really deep on their business and their industry, and they probably know it better than anyone else in the world. And so they can, in my experience, just nerd out in that space. And even when they're pitching to investors, talk about how amazing the product is and all of those things. I guess, like you said, even with Campaign Monitor, of a company that was doing so well and of that size, there was a lot of insight that they hadn't looked at themselves from that was important for investors. I guess from your perspective, is there a common thing that investors look for when being pitched, or when they're considering investing in a company that founders tend to commonly overlook in terms of just metrics or analysis, or even just how they're pitching their story?
I would say no. Like every startup, I'm constantly wowed that every startup is so different. I often actually think people get the problem statement wrong. They're talking about maybe the problem, but not the real pain point. This is 500,000 people struggling with that, but what pain is that causing them? So I think that's the bit that not all, like some people are really great at the pain point and understanding what that is, but really digging deep and pinpointing what's the pain your customers are feeling and how are you solving that actual, like, somewhat physical pain for them. I would say I feel like more generally the accelerators and the programs and the advice out there now versus back in 2013 as an example is so much better, and founders are really educating themselves. But I'm always constantly being like, hey, if you want some feedback on your pitch deck before you take it more broadly to investors, let me have a look and I'll just point out the 2 or 3 red flags that you might see. One that's really common is people put their financial forecasts in there and they've overanalyzed and overthought about it. But realistically, investors just want to know that, one, you want to build a really big business and you have that ambition, and the market size is big enough to achieve that. So like, don't waste time over engineering your financial model or your forecasts. You just want to demonstrate you have the ambition to grow a really big business and you aren't scared by the fact that you need to triple, double, and you have a market size that enables you, if you can take appropriate share, to achieve that. I think I spend a lot of time in financial models still, and they're always wrong. But that's fine. They're not supposed to be right. They're just supposed to be indicative. They're supposed to be tools to help you make decisions, not perfectly hit an ARR number. That's not their job.
Yeah. I mean, for us at Playbook Ventures, we invest primarily in pre-seed and a little bit of seed stage deals. We know whatever financial forecasts they give us are probably wrong. We more use that to look at how the founders are thinking about their business overall. I mean, I'd be curious to get your take on this. We are not naming any names, but we got pitched a company that had a forecast of 75 mil ARR from 0 to 75 mil ARR in 12 to 18 month time period. And I tried to give them some feedback to say, they were very green, tried to give them some constructive feedback to say, just know that this will be a red flag to investors. Either they will, from my perspective, either they will look at that and go, you either are setting, if they believe those numbers, you're setting yourself a ridiculous target that is going to be impossible for you to reach. And then that will set a benchmark for you to raise future funding rounds, which is going to be really hard. Or what most investors are going to say is, you don't know what you're doing, because that is an unreasonable amount of traction in such a short time period, given where you are. They didn't take that feedback. Well, I mean, I think their feedback to me off the back of that was they spoke to a couple of other investors and they said, shoot for the moon and all of those sort of things. And so you should be aiming really high. But I'd love to get your take on something like that crossing your desk. Yeah,
and you gave really good advice. And what I think I'd commend you on and other investors who actually take the time to provide that advice is really valuable, because as you said, there's a lot of green founders. They've heard shoot for the moon and they think that's what that looks like. And you're 100% right. Seeing that come across my desk, one, I would hopefully give them back that feedback as well. But you do. Back to my point, it's so hard. Absolutely. You can be like, yes, there are 300 customers desperate for your product and they'll pay this much. And I can see that path to $750 million revenue for you. I can see that. But getting those customers is going to be incredibly, incredibly hard. And if people can't understand why that might be a challenge, that definitely is a bit of a red flag. Your product's not going to perfectly work the first time. That first salesperson maybe to deliver 200 of those customers might not work out. There's, so many things that are going to be incredibly challenging on that journey, which we know is venture. We're not saying you should be able to achieve that. But yes, you've got to have the right level of founder optimism, because otherwise you'd never start the crazy business. Also with realism and a bit of pessimism of, actually, this is going to be the journey to do it. We're going to need to raise the right amount of capital to achieve what we need to achieve with a bit of buffer to do that. And if they can't appreciate it's going to be a really long haul, it's probably one you want to maybe give them a bit of time, continue to give them advice. But I guess, unfortunately, they'll experience that likely over the next 12 months.
Yeah. I mean, it's such a difficult task for founders to find what that right balance is. And I think in Australia, we probably tend to err on the side of being really conservative at the best of times. And that can put off investors as well, of them going, does this founder have the right level of ambition for this type of company? So it is so hard from a founder perspective to understand what that right approach is. I guess any advice for founders who are thinking about putting that together for the first time?
Yeah.
And the deck and what that should look like to find the right balance.
Yeah. One, I think the most important bit is it's numbers you believe. And as an example, if the numbers that you believe mean it's not a venture scalable business, that's fine. There are other forms of financing that might be more appropriate for you as a founder to help realize that type of business and success and own more of it and have a great outcome. Venture's not always the answer. On the flip side, and we definitely see this with female founders or underrepresented founders who don't naturally have a network of VCs, I am constantly going back to them and be like, these numbers suggest that maybe venture capital isn't the right source of funding for you. Shall we work through them? And as soon as you ask that question, they'll be like, oh no, I think it's going to be way bigger than this, but I don't want to seem unrealistic and people not think that it's achievable. And it's, oh no, like you've got to put a bit more of that optimism and you're putting your best case forward. I think those underrepresented and female founders often say, I'm putting a base case or a realistic case forward, but you've got to put the ambitious case of if you achieved what you think you can personally achieve, these are the revenue numbers that you'll hit. And framing it that way, I think means they'll come back and be like, well, no, I believe in myself. I believe in the business. Otherwise, I wouldn't be starting this business. I do believe it can achieve the 100 mil outcome. I just didn't want to seem like I was crazy. So yeah, and I think just testing it with investors, is what I always suggest. And it's hard when you don't have a natural network, but there's things like One Pitch as an example where you can submit your pitch book and get some feedback. We have office hours at Rampersand. There are plenty of investors who genuinely want to help accelerator programs and I actually think it's really surprising on how many founders don't take that up. So just, you always feel like your pitch deck's not good enough, you're not quite ready, just send it. And actually what investors will love is you give them some feedback, maybe not on your pitch deck, but some thought processes on your business model or your go-to-market strategy, and you take it on and you kind of demonstrate some coachability. And actually that's a really positive signal for us as investors, rather than, oh, we're too scared to send our pitch deck because it's not perfect yet.
Yeah. And I guess that's something that I personally really look for in a lot of those early conversations, is whenever I'm probing, no one's got the perfect answer around that because there's so many unknowns. You don't know how things will play out. You don't know how many customers you will get, all those sort of things. But a lot of it is just testing their thought process, but also testing, are they able to take on feedback on things, not just from investors or people that they're pitching to, but also from potential customers. And are they willing? Because again, most likely the idea and the solution that they have in their mind will change once you take that out to market. It just happens across every business out there. There's no one who's got a perfect exact vision before they've even launched something that plays out that way for the next 10 years. So I think that coachability thing is really important. And so again, what might seem like questions on your financial model, in that example, I was literally just testing them to see how they would react to that bit of feedback. And that told me enough about how they're thinking about things.
And that's why we created the Giant Warm Intro program, was to give people, that is 100% framed as just mentorship for an hour as part of a virtual event. And it's just very low. This is someone who just wants to help you, an introduction to a potential investor, or someone who could intro you to your next investor, but just ask them the dumb questions that you would be too self-conscious to ask in a pitch meeting, right? Or another more formal setting. It's just low barrier to openness with potential investors. And that kind of what you want really early on is someone like you to give good advice back. And then we just tried to scale you as part of the Giant Warm Intro program and bring 100 and something investors along to meet founders to give as much of that advice in a short period of time and hope they maybe take some of that on. And when they do go to pitch investors, they've got a great intro and have some of that really early feedback, and they've just cleaned up their deck like just a little bit. That's all you need is often one round of remove that or take that, or investors going to see that and close your deck, I think is super valuable to founders.
And kudos to you and Rampersand for putting together the giant warm intro. I did a similar event at a much smaller scale called Investor Connect in 2019, where we matched 60 founders with about 20 funds and angels that met their investment thesis but they hadn't met with before. Again, with a very similar purpose of how do you just help facilitate introductions in a informal way that's not just you pitching or feeling forced to pitch, but give you an opportunity to build a relationship and get the feedback that you need early on. But it's a ton of work to put that together. So yeah, it's incredible, obviously, what you've built over there and the impact that it's having on the ecosystem as well.
Yeah, we're super excited about it. It did scale to bigger than we had ever expected, which is a good problem to have. But yeah, I think last year we had somewhere between 120 and 150 investors, most of which we didn't even have to ask to participate. We did scale it slowly. Our first year, I think we had 30 investors. It jumped to 60 investors, then to 120 investors. And it was, what I love about the Australian ecosystem is everyone is aligned with the vision and the mission of what it was trying to achieve, and that everyone just wants to be involved. People are already emailing me, be like, how are we joining for this year? Like, I keep seeing it around. I'm like, we're still working on it. It's coming. And yeah, and the most important part is we're so excited that some of the founders that have participated in the event have gone on to receive funding via maybe not the person they connected with, but they connected them with somebody else, or got some good advice early on that really did help unlock that next path. And so it is a lot of effort, but I'm sure you found this with your experience as well. It's super rewarding when you get to hear those stories on the other side of you helped, and it wasn't me having a half an hour conversation. I can only do so many of those. It's the whole ecosystem banding together and getting maybe people who would not have naturally had that network or door opening to get funding and or just get good advice, which is super powerful.
Not to put any pressure on you, but when is the next giant warm intro?
We are working on it. Our chief ramplifier joined us 2 weeks ago, so that's on her agenda. We're thinking about hopefully doing something at South by Southwest as well.
Amazing. We'll make sure that we include any details into the show notes.
Thank you. We're working on the details.
Okay, perfect. We'll include them into the show notes once that does go live. Something else that I'd love to touch on as well is you mentioning building those relationships with founders early on. Mm-hmm. Again, I think for a lot of first-time founders, they might have this misconception after watching something like Shark Tank. You go out and pitch and suddenly someone's writing you a check 10 minutes later. It doesn't really work that way. Someone I spoke to was Chaz, who is one of the co-founders of Hatch, which is one of your portfolio companies. He mentioned that he reached out to a couple of investors, including yourself, about 12 months before they even started their fundraising journey, and that you were very generous with your time in building those relationships. And I don't know Chaz as well, but I have interviewed Adam Jacobs previously. Amazing. Who was previously the MD at The Iconic years ago. An incredible operator, and I'm sure it was a very competitive funding round for those guys with a great founding team and a big opportunity that they're going after. But again, I think one of the challenges for a lot of founders can be investors say that they want to see us really early. When is the right time, first of all, and how do we build and foster those relationships? So maybe from your perspective, I'd just love to understand, even just an example like Hatch, what does that look like when you're meeting them initially? What do you want to see? And what does that process look like in the months or years leading up to them actually opening up their funding round?
Yeah, great question. I think we'll say it's never too early, and that is genuinely true, but you do need to have a fairly fleshed out idea on what you want to build. I think the most important thing before you meet with an investor is you run a few tests. It's not an idea on a page, but you've gone and you've asked a bunch of customers, or as an example, one of the startups I looked at recently, they launched an Excel spreadsheet on LinkedIn and it's got a whole bunch of different users, which I was just like, that's such a cool way to test your hypothesis that this is what people want. So I think it's an idea and a thought through process, but that you're actually out there proving whatever it is, because that's what investors want, is some proof points that customers want this, or you can tell me it's a problem. Now demonstrate to me that there's I can believe that it is a problem. So that's when I think it's the right time to reach out, is you've got the idea and you've proven up in some way, shape or form it's a problem, and you've got some insight into why you should be solving it. I think the other thing is, from when you reach out to the 100 investors that you have to go and reach out to, work out who asks the good questions, legitimately asks the good questions, legitimately understands the space, legitimately has an insight that they can share from one of their existing portfolio companies as an example, and funnel from that 100 down to maybe 10, 15 investors that you think when you want to pitch, they are the investors that you want and they understand the space, and then really foster that relationship with those people. So I actually don't know how many people Chaz was talking to, but we did catch up over a couple of times over that 12-month period. Rampersand does have a bunch of investments in the future of workspace. We're in Sapia, which is a chatbot for high volume recruiting. We're in Expert360, another marketplace for consultants. Functionally, which is organizational design. Cake, which is employee motivation tool through equity. So we know the future of workspace really well. And through, I guess, catching up with Chaz, got a few of this is what we're testing, this is what we're learning about. And so even if it wasn't a must running hard at it, even though you're not raising 12 months earlier, we've built that relationship. I understood more about how those guys operated. They hopefully understood more about how I operated and how I can add value, how it just was on the space and to learn more. And then when it was time to raise, we could get there relatively quickly. Both knew each other well enough and then go from there.
Yeah. I think that Chaz mentioned as well was, to your point of someone who asks good questions, he said that obviously they have a marketplace business. A lot of other investors that they spoke to had very specific questions around revenue and metrics versus you really dug into the product, the users, the roadmap. Is that your general, I guess, what are you looking for when you are looking at companies that early on in their journey?
Yeah, and because they are slightly later stage than a traditional seed business, but because often seed businesses don't have revenue, we want to know what are the earliest indicators for you that revenue will come. And so for the Hatch team, we have potential candidates coming to our platform, setting up a profile, and they're coming back next week. Or they applied for a job because they saw it on a job ad, and then they've come back and checked their profile and seen the process. So that kind of, that the candidate's never going to pay, but that kind of traction, any form of indicator that, people are coming back, you're solving a problem for them, they're loving the experience, is definitely helpful and amazing. I think on the employer side, the customer testimonials that the Hatch guys had were phenomenal. And yes, there were recorded videos in their pitch deck, which a few people do, and I think that's really helpful. But I've never seen a customer rave so much about the product as what those guys were building. And obviously we did customer calls because we're like, this is too good to be true. And at the end of the customer calls, we're like, they sold it even more than what they did in the testimonial. So for us, particularly for Hatch and for other businesses, customers who are loving you, absolute customer love, is another really good signal, once again, even pre-revenue, that you're solving a big problem for them and they definitely want to be on the journey and use your product.
Amazing. And one other thing that Chaz mentioned, he mentioned a couple of things. One other thing that he mentioned was that you were critical in helping them bring forward their revenue, because he said usually marketplaces generally wait a little bit longer to introduce revenue models through that. But a lot of the work that they did with you was reassessing that strategically. Do you want to talk a little bit about what that process looks like? Yeah,
and to be honest, that was a bit more driven by the capital markets. As your audience would know, it has been a much more challenging time for startups to raise more recently. And so particularly for Hatch, I was like, look, it's great that you have, and to be honest, this is before we saw the customer videos, but it's great that you've got all of these, they had customers on the platform, but they weren't paying yet. That's awesome. You're providing value. But in this market, you're going to have to show that with revenue. And that was much more driven by the capital markets than necessarily what was right for their business. But I don't think that was the wrong decision either. Founders can be a bit conscious that maybe the product's not perfect. They want to provide more value before you go and you ask your customers who have been trialing your product, giving you great feedback, being really helpful, asking them to pay for that product. It's hard. And so I think a little bit of a push on that didn't help either. Guys, you've provided enough value. They love you. It's time to start charging them. Yeah,
it is really hard from a founder perspective, I guess. Sometimes the illusion of something is a little bit easier. So when you're directly asking someone like, hey, is this valuable enough to put your cash down? That's a very scary moment, as you said, for people to make a decision one way or another. Versus, I guess for founders, it can be easy to let that just keep going for a little bit longer because you can avoid that hard conversation.
Absolutely. And Also, some founders always start with, we're going to charge $10. You're like, that's great. That's an easy sell. But like, your product's worth $100 per month. And similarly, I think, once again, part of the investor's job is founders know that, but sometimes you need a little bit of a prod, be like, you're right. It's time now that we ask our customers to pay for the value that we're providing.
Pricing's such a tough one to get right. And I feel like so many times I have conversations with founders to just say, you are massively underselling and undervaluing this. And sometimes they've got some really good reasons behind it, but oftentimes, as you said, a lot of it just comes from a place of fear or insecurity. I think especially when you're struggling to make any traction or trying to drive up traction and momentum, having someone walk away from something just because it's a little bit too expensive feels like a gut punch, because it feels like you've just lost an opportunity there. But you, again, doing yourself a bit more of a disservice in the actual success of the business if you continue to massively underprice long term.
Yeah, and I was talking to a founder the other day, and they were just selling their product too cheaply. And so customers were like, well, you can't be delivering all of the value that you say you are, because that's too cheap. And we know how hard this problem is to solve. And we don't believe if you're charging us that much that you're going to solve it for us. And they just noticed actually charging the reasonable price meant that people were like, oh, okay, like you're a real product now. I believe you. If I'm paying this much, I'm expecting you to deliver. And they obviously are. But yeah, so underpricing can actually be a negative as well. But I think the really hard thing with pricing is there's no right answer as well. People want to be like, the price is $100 and that's definitely the right price. You've just got to test and learn.
Yeah.
It's the only way to do it, I think.
One of the best bits of advice that I got, I was running a marketing agency for a while that I accidentally fell into. But one of the best bits of advice that I got from an advisor was just keep doubling the price until enough people say no.
I love it.
And that is so scary to do. But yeah, I just found that I was charging a quarter of what people were really comfortable paying. And I think a lot of it is trying to value yourself and value your time, but actually what the end customer is looking for is the value that they and the benefit that they get from you solving that pain point for them. And if it's a big enough problem and your solution is that good, yeah, it's worth it, and they will pay for it. It's just tough to mentally make that leap.
100%. Yeah, it definitely is tough, but it seems like it worked well for you.
Yeah, worked well. It was super scary though. Again, any advice for founders, like you said, in terms of just finding what that right price point is?
I'll be honest, I'm not the expert on it. I genuinely think with many things in startups, you do just have to test and learn, and doing that testing process and taking the right bets on, okay, we will test in this small region or for this type of this customer set, or we'll just move this, particularly for like PLG products, we'll move where the paywall is, and just playing around with it a little bit is the best way to figure it out. I don't think investors can necessarily tell you the answer there, but helping you work through what are the tests that maybe you should run, and having that discussion and once again, having that person who's one step removed from your product to work through with that. That's all we want to be, is that soundboard for you when you're thinking about it. But I think most of the time it's just test and learn.
You would have heard me say many times on this podcast before that I am such a big believer in surrounding yourself with the right people. And that's why I'm delighted to partner with Sendle. Sendle is the OG startup accounting firm in Australia, catering to all stages of your business life. If you're busy running your startup, you don't always have the time to balance your own books or do forecasts, and instead you can fully outsource your finance function to give you the time, energy, and resources that you need back to do what you do best, which is growing your business. They have a dedicated focus on founders, funders, and startups, and have an experienced team that can help you with everything from managing your tax to balancing your books to even helping with your exit strategy. I trust and use them with all of my businesses and can't recommend them highly enough. To find out more or to speak to Gareth and the team, head over to sendle.com. That's SCENDAR.com. All right, let's get back to this episode. And you referenced this a little bit earlier in terms of Paul Naftali, who's the founder of Rampersand. He did mention the initial conversation that he had with you, and he said it took about 6 months for him to get around to bring you on board. One thing that I think Rampersand is probably known for, but maybe not as well known for, is your kind of AAA process, as he describes it, which is attract, assess, and amplify. So I think he said one of the most challenging things about finding someone to join the Rampersand team is someone who can sit across all three of those buckets. And I think that a lot of funds probably focus on the first two, which is attract and assess, which is how do you find opportunities, how do you do due diligence and find the right companies to invest in. But from what I've heard, you guys spend a lot of time on actually amplifying, which is supporting the companies in your portfolio. Again, do you want to share a little bit about what that specifically looks like from what you do for your portfolio companies, but just Rampersand's approach to it overall?
Yeah, absolutely. And I like to Paul's point, it is really important as we think about hiring. So within the Rampersand team, I say our jobs are all the same. We all work end to end. We all have to attract, we all have to assess, and we all have to help with amplifying. So hiring, even at a junior or more senior level, for people who do that is really important for our process. On the amplifying side, I think it is, we can all sit in board meetings and catch up monthly, and that's really important, and we love to stay in touch and have those conversations so we're on the pulse of when things are happening, and so we know, oh, like you're thinking about that, let me introduce you to that person, rather than founders necessarily always having to ask for something like, oh, I know someone who can help you with that process, let me connect you with them, and being really proactive in that way. But most importantly, it's like we call it choose your own adventure. We always want founders to want our help. We're not ever forcing ourselves on them, but we share where we think we can be helpful and lean into those ways. And sometimes it's really heavily leaning in. So as an example, for one of our portfolio companies, they didn't really have anyone who could help with that financial model. And so we don't want to build models for our portfolio companies. We definitely can if they want and need that help, but working alongside their finance team to understand these are the growth levers here. Here are some of the expenses. These are the expenses in your business, and working through with them so they understand they own the model, but we can help and support in that process. We do get very actively involved in capital raising, once again, when the founders want our help. But obviously that's what we do all day, every day, is talk about raising capital, see founders pitch decks that resonate, see what the exciting messaging is that we can help with and help communicate around the founders that we support. And so we do lean really heavily into helping our portfolio companies raise capital, because that is actually something we can be pretty helpful with. And to the extent that, we like fully lean in and help run that process end to end, once again, if they want that support. Paul is amazing at PR marketing and comms. I'm still learning, but it is actually such an asset for startup. And just having a little bit of PR around you so that when someone Googles you like, oh, do I want to use that product? Okay, they're legit. They've been in some media. They have an investor on board. And amplifying that message can be really helpful. But that's a huge thing that when we're talking to founders we want to invest in, we can help you do that. It's not something you want to hire full time. But a couple of coaching sessions with Paul around your PR marketing and comms and we do that pretty early after we've invested in each startup, can really help define your message, make it really clear to your customers, and hopefully get a bit of PR around it as well.
Amazing. And there's two things that I wanted to touch on. One was you mentioned financial models, and I think I totally agree with you in terms of, I think they can just really highlight what are really important levers for your business. But even from a marketing perspective as well, you can have 20 different ideas, but I use this framework called ICE, which just helps you score and be a little bit more deliberate with where you're spending your energy, because not everything will have the same impact. And although you can look like 20 different ideas all equal, actually, if you do the numbers on it in terms of the impact and what it will take, it can make you a bit more focused in terms of how you should spend your time, energy, and resources. I think financial models, just to your point as well, can do the same in terms of just understanding the really important growth levers in your business. I would say most founders may not necessarily come from a financial background, or that not be the most fun thing for them to do. Any advice in terms of how they can, if they don't have the benefit of having Rampersand's team around them to support them in this area, any advice in terms of how they can get started or what that first step would be?
Yeah, I mean, it's to be honest, like the financial model is much less about the numbers in there. And as you said, it's exactly about understanding the levers in there. So part of it is just, if we want to spend here, what are we expecting the outcome to be? And going back a month later and say, okay, we spent that and this was the outcome. So did that work, or was that not the best course of action? And so really just basically thinking, these are the 5 decisions we might need to make. When are we going to hire more people? How are we allocating our marketing spend? When do we want to launch overseas, as an example, and putting them down, and you've got a roadmap, right, of when you think those things are going to happen. And then just equating that to, okay, well, this is the financial targets we want to hit before we know we're ready to launch into that next market. Or we can see that our sales executive is selling to this level. great, it's time to bring on another one because our pipeline's this big. So financial model is it can be scary. People don't love them. But I think if you think about it as a way to make decisions and like just have some numbers to support your decision making, which founders do love. They love to have data to make decisions. Financial model is just another data source to help you sense check your decision. Like, yes, that lever's working. Now is the right time to hire. We've got like enough momentum in Australia. Let's expand overseas. It's just another tool or another data source that you can use to make those decisions rather than it being, shit, we missed our revenue forecast. That's not the point of the model. But on the flip side, when you smash it out of the park, it's a good chance to celebrate as well.
Absolutely. And the final thing that I wanted to touch on, and you referenced this a little bit earlier as well, is it is such a tough capital raising environment. As you mentioned, it's something you see all day, every day. It's something that you support your portfolio companies with as well. What are just strategies, tips, or just things that founders should be mindful of, particularly in this environment? Are there particular benchmarks that you're seeing that founders need to hit that are helping get them across the line? Just would love your perspective.
Yeah, I think back to your earlier point, it really is about building those relationships. And I think, unfortunately, now it's just you're going to have to build them for longer and you're going to have more proof points with an investor to demonstrate that you're the founder who can achieve this big, hairy, audacious goal. So I don't think, particularly at the seed stage, there's necessarily metrics that people are still looking at. I think it is becoming even more important later in the journey. And that is something we work with our founders with. It's like, we've invested at seed, there's a lot to work out, but what do we want to, what your next round investor want to see at that Series A? And let's use that to help us plan after we've invested. But leading up to seed, it's still very much art, a lot less science. So yeah, building those relationships, the more proof points that you can have to be like, yes, I've demonstrated that, or I've got maybe a few more paying customers. That's everyone's just expecting to see just a little bit more, unfortunately. So for founders, don't get disheartened when that's the case. When an investor says, we need to see more of that, and you go and demonstrate that, go back to them. Like, we're expecting that. That's what we want to see. Re-engage us once you've hit that spot where we're looking for, we hit the sweet spot for our investment.
Amazing. Taryn, thank you so much for coming on the show. It's been an absolute pleasure. Thank you for being so open with your experience, lessons, and insights. For anyone that wants to find out more, say hello, get in touch, what's the best way for them to do that?
I'm probably best on LinkedIn. I've got a very hard name to spell, but hopefully you'll find me.
Perfect. I will make sure that link is in the show notes. Taryn, once again, thanks so much for coming on.
Thank you very much for having me. I appreciate it.
Thanks for listening to episode 190 of the Startup Playbook podcast. As always, full show notes from this interview will be available at startupplaybook.co. I'll be back next week with another episode, but in the meantime, if you enjoyed this interview, please don't forget to like, share, and subscribe. As always, thank you for tuning in, and I'll see you next week.